When it comes to retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement plan at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now. Coming to you from the ILG Financial Studios, this is Retire Your Way, the podcast that gives you the straight talk and honest insight you need to help you achieve your financial goals through smart investing and careful planning. My name is Jeff Shade. I'm just here to ask the questions, of course, but the words of wisdom and solid advice come from Dave Lopez, managing member and owner of ILG Financial. How you doing today, Dave?
I'm doing great. It is always good to be back together with you and the listeners, and really a great show we've got planned today, I think.
Yeah, I'm excited about this one. Of course, always great to be with you, too, because we learned so much from you there at ILG Financial. But yeah, I agree. This is going to be a great show. And, you know, I think some of the great conversations that we have are actually off the air. So I want to share some of those on the air today. We were talking before we went on the air today about some flags that people are missing in the market. You know, times are tumultuous these days, and what has worked in the past may not work in the future. We were talking about the traditional 60-40 stock bond split and the fact that today things are just so much different. I mean, you know, the average interest rate or the average return that you're getting on a split like that is actually less than inflation. Tell me more about that, Dave.
Yeah, it's very interesting. This was actually from an article that crossed our desk from Business Insider, and it was just put out. And it was titled, "A Disturbing New All-Time Low in the Markets Just Flew Under the Radar as Stocks Hit Record Highs on Wall Street." And it goes on to say a Wall Street expert warns that it implies years of, get this, years of bleak returns for young investors. Now, of course, that's any investor, right? Not just young investors. I'm not going to read the whole article to you, of course. That's not necessary. But here's the takeaways, right? What they're saying is these warning signs they're reading in the market are saying a couple things, which is the price to earnings are completely out of whack, which basically means the stock price is completely out of whack with the amount of earnings that these companies are making. And historically, they have always reverted back to mean, which means they've always gone back in line with historic average. And if that happens, it is very likely that just like '08, just like 2001, we could see a crash in the 40 to 60% range just to get us back to the price to earnings ratios that are average. So it begs the question, Jeff, for folks in or nearing retirement, right, that, you know, this year with all the tumultuous ups and downs in the market, the huge drop in March and then the huge run back, you know, as of the end of September, the market was down for the year. So if you lived through all of that and didn't panic, you actually aren't up at all. But it does beg the question, if we're still near record highs as of the recording of this podcast, and you have to ask yourself, as someone in or near retirement, if the market does correct 50, 60%, like it's done twice in the last 20 years, and let's say it takes 5, 6, 7, 10 years to recover, will your portfolio survive with you taking money out and living in retirement with a 50% drop that takes that long to recover? The article goes on to say most of us have been told to, you know, use a traditional stock bond split, 60 stocks and 40 bonds, and you should be fine. And the reason is that the 120-year average yield, that means the income that's spit off by the stocks and the bonds annually, on a 60-40 split, the average is 4.11%. The current average today is 1.37%. 1.37. So again, what it begs the question is, if you've been told for years, just keep some in stocks and some in bonds and you'll be fine, it's based on this 120-year average data. The problem is you're not going to be able to count on that average for the 20 or 30 years you're in retirement. And currently, we're in an environment where you're getting 1.37. That's a third of the historic average. Treasury notes are under 1%. So this portion that we had on the bonds for our stable side, our safer portion of our portfolio, worked in the past because you got better interests. Now, what this article is inferring is what worked before, the traditional stock bond split, very well could bankrupt you moving forward if you're expecting historic averages. And the result is we can still do something like a 60-40 split, Jeff. We just need bond alternative vehicles. We need other investment vehicles that give us what bonds used to give us and the chance of better returns. And better returns, I'm talking 4 to 6%, but still have the attributes that we wanted in a bond, which is, principal protection to some degree. So that's what we talk about to folks is we can still do that 60-40 thing if that's what you like, as long as we're using something that can do better than these ridiculously low interest rates that you're finding currently in the bond market.
Okay, Dave, so you set me up for this next question. What are some alternatives to this traditional 60-40 stock bond split?
Well, there's a couple, right? But the one that we want to kind of focus on today, which is just a great example of an ideal fit in this situation. For example, this idea of taking some of your chips off the table in the market, or even just leaving your stock market stuff in the market if you're willing to take that risk, but maybe moving the stuff that you have traditionally in bonds to an alternative vehicle. Vehicles like, and we'll get into it today, and again, I appreciate you saying that. I want you to hold our feet to the fire. Let's get some tough answers to questions on these alternative vehicles. Specifically today, let's talk about the fixed indexed annuity, because it's a misunderstood vehicle. And as a result of it being misunderstood, I believe a lot of folks are missing an opportunity for better gains because they're basing their decisions on investing on bad information. And as a result, they may be leaving their money in vehicles that are giving them a chance for much lower returns.
Well, Dave, fixed index annuities is something that we hear about all the time, but what are the real advantages of using them as an investment tool? What's the real truth here?
Well, the real truth is that it is a vehicle that's been around for well over 20 years, so this isn't some new vehicle. It's a vehicle that gives you principal protection, which is what most people look for in a bond type vehicle or a CD. However, it gives you the opportunity to do much better than a bond or a CD. So we can talk about how that is, but just to give you a big picture to decide if this is something that's you're interested in listening more, we've got back-tested results on some of the fixed indexed annuities that over the last 20 years, if we look at the best possible time you could have gotten invested for a fixed indexed annuity to produce income, and a worst possible time to get invested as far as returns, they have back-tested results between 3.95 and 7.84% in 10-year annualized returns. Now, whether you get 3.95 or 7.84 or a little less than that or a little more than that, time will tell. But that's no different than the stock or the bond market. But the fact that we've got data to suggest that you've got a realistic chance to make between 3 and 7 and still have principal protection, I would suggest that's a tool that would be very attractive to somebody who has 40% of their money in bond vehicles with a yield of 1 to 2%.
Well, Dave, all that makes a lot of sense to me. I understand it completely, but still there are a lot of misconceptions about fixed index annuities. Can you elaborate on that?
Yeah, so let's just touch on a few. A fixed indexed annuity, first of all, it offers you the ability to earn interest on changes in an external market, like the S&P 500 or the Dow or another market index. But while it's doing that, it's offering you protection from loss of principal if the index declines. You see, your money is never actually invested directly in the stock market index. So you don't have to worry about losing money if the stock or the index goes down. You're not actually owning stocks, bonds, or index funds. So when you buy a fixed indexed annuity, what's happening, very simply, is the insurance company is pooling your money with another group of folks just like you, and they're investing in long-term vehicles and giving you a guaranteed minimum value and guaranteed minimum interest rate on the growth of that. However, based on how market indexes do, if the stock market index does better, you get better interest. Insurance companies offer resources to help you fully understand exactly how a fixed indexed annuity works before you get involved. That's a lot of my job for my clients, is to walk us through exactly how any tool works, not just a fixed indexed annuity. We go over the advantages and the disadvantages. As I said before, you don't want to miss an opportunity for better returns or even the chance for better returns returns because you didn't have the right information. We can get you that information. Finally, I would point out that a fixed indexed annuity, they offer additional benefits that you may not get in a bond. Things like tax deferral, if you don't want to pay taxes on some of the money, guaranteed minimum value growth. If you pass away, of course, your heirs get the money. It's not like a pension where if you die, they don't get anything. It's more like any other account. When you die with a fixed indexed annuity, your heirs get whatever's left in the account. And unlike other vehicles, you have the option, not the requirement, but the option at any time of saying, hey, can I turn this on for an income guaranteed for life, which you may or may not ever do, but it really is nice to have that option.
So far, so good, Dave. These sound pretty good there. Now, you talked about getting a percentage of the market when the market is up, but the natural question that comes to my mind is, what happens when the market goes down? Do you lose money?
Yeah, it's a great question. So the short answer to that is you don't, but you decide if you want to have any downside exposure, Jeff, you decide. So let me give you a great example. Remember when I told you earlier that when they did some of the back testing on some of these annuities, they looked at the worst case and a kind of a best case over the last 20 years, and the range was on the low side 3.95%. The upside was 7.84. Now be clear, we're not saying you will earn that any more than looking at historical returns of a mutual fund promise that you will guarantee to get that return in the future. But what you are promised with a fixed indexed annuity and backed up by the insurance company is that if the markets do terribly and go down, you will never lose more than your floor. Right? So most of the fixed indexed annuities have a floor of 0, which means, in layman's terms, if the market next year drops 40% and you put $100,000 in your fixed indexed annuity, at the end of the year, you have $100,000 in your account. You didn't get any interest, but you also didn't lose 40%. And most of the folks who get a fixed indexed annuity that we work with, they like the idea of getting a realistic chance to earn, 4 to 6%. But they're really getting it for that 0% return that they're guaranteed if the market tanks.
Okay, that's music to my ears, Dave. You get part of the upside, but you do have a floor of 0, so you have the option of not losing money. I like that. A lot of people, when we talk about these vehicles, investment vehicles, and I know that these are not Wall Street vehicles, but they're insurance products, they're very concerned about the fees. So what about the fees? Do fixed index annuities have high fees?
Yeah, boy, this is one of the biggest misconceptions. When they talk about annuities, they talk about high fees. And the challenge is most folks don't even know, Jeff, that there's really 4 different types of annuities, and they're completely different. Today, we're only talking about one type, the fixed indexed annuity. And many fixed indexed annuities have no fees at all. No fees at all, just like a CD doesn't have a fee. But remember, nothing's free, right? So what's the true cost? Let's get right to it. The true cost is time. So just like a bond or just like a CD, you get better interest if you're willing to let the company hold the money for a longer period of time. So you get a better rate on a CD if you take out a 10-year CD versus a 5. Would you agree?
Exactly, I would.
Yeah, but you have to tie the money up for longer. It's the same with annuities. Even though you're not being charged a fee on most of these, you're agreeing to limit your access for a certain period of time. And it can be as little as 5 or 6 years. It can be as much as 15 years or anywhere in between. You decide. But usually, the longer you are okay with limited access, the better interest rates that they will give you when the markets are doing well. So the takeaway is you'd only want to put money in a fixed indexed annuity that you don't need to pull out during the period that you agree to. Now, the beauty of a fixed indexed annuity is you still have access during that 5-year period or 10-year period or 15-year period. Most of them will allow you to take out up to 10% each and every year if you need it. Now, here's why that's so attractive to so many people in or near retirement. Most folks in retirement have no intention of ever taking more than 10% out of their retirement accounts ever because they've done the math, and you probably have too. And if you take 10% a year out of your retirement accounts, you're going to be probably broke in anywhere from 10 to 15 years, depending on your return, or maybe as little as 7 or 8 years if the market tanked and you went backwards. So the idea for folks in or near retirement of limiting their access to some of their buckets to 10% is often not an issue. But for folks listening today, that's a great litmus test, right? So if you're thinking about, hey, maybe an annuity might be an option for me instead of my bonds or something like that, the first thing you would ask yourself is, hey, for a chance at better returns, am I okay with this bucket of money limiting my access to 10% a year for the first 5 or 7 or 10 years? Now, the way we do that with our clients is, you've heard the phrase, don't put all your eggs in one basket. It's still true, right? Just like the 60-40 stock split. So you would only have some of your money maybe in a fixed indexed annuity, just like you'd only have some of your money in bonds. Other money we would put in vehicles like mutual funds, exchange traded funds, even conservative ones if you were afraid of risk, right? But those would have unlimited access. So if you needed money, imagine this idea that if you needed money and the stock market is up, we take the money out of the money that you have in the market, because isn't the goal to sell high? But what if you need money a year later and the market's just tanked? We'll let the market money sit and give it a chance to recover, but we'll take a 10% withdrawal out of our money that's sitting safely in a fixed indexed annuity, so that now you're never having to sell low. Now you're not a victim of the market. So the idea is to have some in each market, but there's one misconception about fees. There's many fixed indexed annuities built out just to grow the money safely, have no fees, but your cost is limited access over a specific period of time. The other cost I want to point out, because we're big here about, and I love what we do together on this show about, cut all the baloney and let's get right to it. Would you agree, Jeff?
Oh yeah, no baloney here. This is a no baloney zone.
So another negative to in the way, it's not a fee per se, but you don't get, when the market's up in a fixed indexed annuity, and this will make sense to almost everyone listening, you don't get all of the up, right? If the market's up 15%, you won't get 15. You get a portion of the up because you're being protected from all of the down. So remember I told you when we back tested over the last 20 years, and the best month you could have ever gotten in for a 10-year run on some of the annuities we back tested was like an annualized return of like 7.84%. Well, in that same period, knowing what you know now, had you invested in the market, you may have averaged 15% or 12%. You see? So, nothing's free. You can't get all of the up in the market and none of the down. So all you're doing is you're saying, hey, I'm okay with less of the up in return for none of the down. Less of the up for none of the down. Now, the argument is you're already doing that if you don't have all of your money in the stock market, aren't you? If you're in a 60-40 split, Jeff, the 40% you've got in bonds, you already aren't getting the up in the market. But the problem is, as we addressed with that article from Business Insider, is now we're looking at more like none of the up in the market, but maybe 1 to 2% return in the bond side. So I would propose to folks that you want to consider a fixed indexed annuity as an alternative, not necessarily to your money in the market. If you think when the market's good, you're going to get great results, think of it first as an alternative to I would call your safe money, the money you want in cash or CDs or bonds that you're willing to leave for a little bit longer period of time in return for getting a better interest rate than the bank account. Make sense?
Makes a lot of sense to me, Dave. We're talking about annuities with Dave Lopez, in particular fixed index annuities here on Retire Your Way. Once again, Dave is with ILG Financial. Of course, ILG stands for Income, Legacy, and Growth. And if you've got questions about anything that we've talked about today, in particular annuities, of course, Dave is there to answer your questions. His number, 540-720-5656. It's 540-720-5656. Of course, you can always find out more about the firm and email a question in at ilgfinancial.com. Dave, let's continue our conversation here about fixed index annuities. Let's take a look at another misconception or area of confusion, and that is that fixed index annuities can tie up your money for years and years and years.
Yeah, we just addressed that a little. And as I mentioned before, the usual surrender period on fixed indexed annuities today are somewhere between 6 and 10%. There's some that are more, but you would choose the ones that are, say, 12 or 13 years because you would want the better interest. And maybe you didn't mind tying the money up, just like picking a 12 or 15-year bond instead of a 6-year bond. But during that period, you have limited access. Usually it's about 10% access a year during that 6 or 10-year period. And if you pull out more than your free withdrawal, you pay a penalty. Right? So that's a definite downside, right? So you only want to use money into these buckets that you are as comfortable as you can be, that you will never have to take out more than 10%. Now, an exception to that that the companies have built in are major life changes. And most of them, not all, but most of the fixed indexed annuities will give you an exception to any penalty during that 6 to 10 year period if we have a major life change. And they would usually include those as 3 examples. One, of course, is if you die. If you die, your heirs, whoever is the beneficiary of this account, just like any other account you have, gets the money. There is no penalty because the 6 years isn't up or the 10 years isn't up. They get the money, and they can do whatever they want with the money at that point. So you don't have to worry about you dying before the period's up. Now, that's not necessarily true about a bond. If you buy a 10-year bond and you pass away 1 year in, the heir gets the 10-year bond, and if they want to get out of it, they've got to sell that bond on the open market. And if it's worth less than what you paid for it, they've got to sell it at a loss. The annuity allows your heirs to walk away with whatever you put in, whatever the current account value is at the time of your death, just like most accounts. So for most folks, 6 to 10 years or 12 years, whatever you pick, for your retirement accounts, knowing you have access to 10% a year is a blip on the radar. Again, but that's only for part of the money. Another way, Jeff, you can access the money if something happens in your life is, let's say that you have to go into a nursing home. Well, for most carriers, even if the 6 years isn't up or the 10 years isn't up, if you have to go into a nursing home, that happens after the first year, you can have access to all the money if you need it, which is a nice extra. So a lot of our clients, instead of getting long-term care insurance, might consider just putting a bucket of their money over here in a fixed indexed annuity to sit and grow, knowing it's available if they need it for long-term care, and if it's not, they'll pass it on to their heirs. Another exception would be if, God forbid, down the road, the 6 years isn't up, and you're diagnosed with less than a year to live, and you've decided you want to take that money and sail around the world, you can. If something happens and you're diagnosed with less than a year to live, you can forget about the 6 year or the 10-year period, and you can just walk away with the money. Again, as an example, not true with a bond, right? With a bond, to walk away, you've got to sell the bond on the open market, and it's going to be worth what it's worth at the time. And if interest rates go up, which they inevitably will do, they always have historically eventually, then your bond is worth less. So if you have to get out early, you've got to sell it at a discount. So I draw these comparisons. I hope I'm not being redundant, Jeff, to show you that the limitations here are very similar to the limitations to a bond, which people are very comfortable holding for the money they don't want in the market.
Great explanations, Dave. And, I think the key really to fixed index annuities is just understanding how they work.
That's exactly right. And you know what? That's a great takeaway, Jeff. That's true of any investment vehicle, isn't it? You want to understand before you get involved the advantages and the disadvantages of any mutual fund, any exchange-traded fund, any piece of real estate, any annuity, any long-term care product. You just want to understand. And what we have found after building out hundreds of plans, right, is the folks we deal with are very bright. That's how they've accumulated wealth over the last 30 or 40 years. They can make the decision very easily as long as they have all the data. But this is a wonderful example of a fixed indexed annuity. It's just one example of an investment vehicle that most people, not only do they not have the actual data, but they have misinformation or partial facts. So they're basically trying to make their decision based on myths or misinformation, and it could be costing them money because they don't have the facts. So what we propose is not that you get a fixed indexed annuity. What we propose, Jeff, is that you get the facts. And we spend our time with our clients walking them through the facts about not just this tool, but all the tools.
If you want to know more about fixed index annuities or just annuities in general, once again, that number is 540-720-5656. Income, legacy, growth, it's all right here at ILG Financial, and it's about helping you plan for your retirement your way so you can achieve your financial goals. Once again, that number 540-720-5656, or you can go online to ilgfinancial.com to learn more. Dave, out of time for this week's podcast. Of course, we have a lot of other great topics in the future. And if you'd like to hear other podcasts, of course, they are available right here on this site or wherever great podcasts are heard. So for Dave Lopez, I'm Jeff Shade. Thanks for listening to our podcast today about fixed index annuities. We'll talk to you again next time with another edition of Retire Your Way. Have a great day.
The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of AlphaStar Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through AlphaStar Capital Management, LLC, an SEC registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. AlphaStar and ILG Financial, LLC are independent entities.